Rumors of an imminent diplomatic deal to reopen the Strait of Hormuz sent crude oil prices tumbling today, unleashing a sudden short-covering surge across U.S. equity indices. As geopolitical risk premiums evaporate, short sellers who bet against the tape found themselves squeezed hard during early trading. Energy price relief acts like an immediate tax cut for American consumers and corporate margins alike. With the administration pushing to bring fuel costs back down ahead of the upcoming midterm elections, lower oil prices are easing near-term inflation fears and giving risk assets room to breathe. That relief pushed the S&P 500 up to touch new all-time highs around 7,750 today. Remarkably, strong corporate earnings growth over the past 2 quarters means index valuations are actually cheaper now than they were at the start of the year, providing fundamental backing for this leg of the rally. Underneath the broad index surge, regulatory developments created huge moves in technology hardware. Reports surfaced today that the FCC is drafting measures to restrict imports of Chinese-made optical transceiver modules, aiming to secure data center infrastructure against potential cyber vulnerabilities. That news ignited a 12.8% surge in optical chipmaker Marvell Technology. As high-speed data centers expand, optical digital signal processors from domestic suppliers like Marvell and Broadcom become essential components for hyperscalers upgrading their network backbones. At the same time, AMD posted blowout quarterly results in its hardware segment. AMD's data center revenue reached a record $6.7 billion, up 100% year-over-year, and now makes up 58% of the company's total sales. That confirms that hardware demand from cloud providers remains intensely active. This rapid top-line growth shows how strong fundamental earnings are absorbing heavy infrastructure spending across the semiconductor space. Rather than draining corporate cash balances without return, capital expenditures are converting into real revenue for primary chip providers. Macroeconomic data presented a more complex backdrop today. The June JOLTS report revealed an awkward split in the labor market. While overall job turnover is slowing down in a disinflationary trend, structural supply is shrinking as older workers retire, keeping wage pressures sticky. Liquidity conditions are also adjusting as the Treasury Department releases its third-quarter refunding announcement. The mix of bill and bond issuance will dictate how fast commercial bank reserves drain over the coming autumn months, directly influencing short-term money market rates. Looking ahead over the next 2 quarters, monetary policy is likely to transition from a helpful tailwind into a neutral or restrictive headwind. With the Federal Reserve pausing its rate cuts to evaluate incoming inflation data, financial conditions won't stay as easy as they were earlier this summer. That policy transition coincides with a well-documented seasonal risk window. Midterm election years historically bring 10 to 20% market pullbacks between mid-August and September, suggesting that chasing new index highs right now carries elevated downside risk. Interest rate futures are already pricing in that caution, showing a 57% probability of a Fed rate hike at the September meeting. Meanwhile, the 10-year Treasury yield is creeping higher toward 4.6%, creating potential valuation friction for growth stocks. The tactical takeaway for investors is to enjoy today's short covering momentum while remaining disciplined. Focus on high free cash flow hardware winners with clear regulatory and product moats, while keeping cash ready to deploy during any seasonal weakness in late August.